So welcome everyone to Columbia University's 19th Annual Social Enterprise Conference, Capital for Good digital event series this year under the pandemic. This series showcases social impact, innovation, and leaders who are deploying capital to generate sustainable solutions to global and environmental systemic challenges. We hope today's event and this series of events that we're running serve as a terrific forum to engage on in a virtual way with the exchange of new ideas and best practices from mission-driven organizations and businesses and speakers. So I wanted to share a slide. For those of you who have joined us before, you would have seen this particular slide. It's what we call the spectrum of capital for Good at Columbia Business School and the Tamer Center for Social Enterprise. And here you can see, at the Tamer Center and at the Business School, we're interested in capital and all the tools in the toolkit, from responsible, sustainable ESG investing, impact investing, whether it's return first or impact first, through to strategic philanthropy and then pure philanthropy. We think that the social and environmental problems that are facing us in the world are so huge, we need more of all of it. And this series serves as a terrific forum to explore all the different topics under this. And, it's just, if you can think of the metaphor of building a house, a builder will use every single tool at the appropriate time. And so having flexibility and a broad-mindedness to learn about how to use all these different instruments, we think is a terrific practice at Columbia Business School. So with that, let me stop my screen share. Or Matan, if you can switch us over, thank you. And I'd like to now turn to a few introductions. First is Professor Mark Zurack. Professor Mark Zurack has been at Columbia Business School for quite a long time, has been a terrific teacher of capital markets and investments at the business school and teaches on equity investments and derivatives. He's also teaching a new ESG equities investing class at Columbia Business School, starting in a couple of weeks this spring semester. And so we're really delighted that he's here. He's also a former practitioner. There are many Goldman Sachs alumni who still ask after Professor Zurack and how he's doing. So we're thrilled. And he's also a terrific contributor through his board service at terrific organizations like Teach for America and also the Tamer Center for Social Enterprise. So thank you so much, Mark. And then just in terms of order, he will be followed by Sam Mindlin, who is a current MBA student, a star organizer for us in this series, and who will also be in Professor Mark Zurack's course. So with that, I'd like to turn it over to Professor Zurack. Thank you.
Hello, everybody. Welcome. Thanks for zooming into our webinar. I'm actually going to just go through a few slides that I actually have created as part of the course. And I'm attacking ESG investing in the course in general from an asset management capital markets perspective, from a risk perspective. So the slides are going to reflect that, but might as well start. Someone's turning them, I presume, because I'm not. Oh, beautiful. Okay. So what I'm going to start with is a classical efficient frontier slide. So the way I'm going to attack performance, and I'm going to look at it from a somewhat academic perspective with the speakers following me with a more of a practitioner perspective and more in the trenches perspective, I think. But what this chart shows you is your classical efficient frontier. And the theory, I think, which is kind of the way I started thinking about ESG, is that if I'm constructing a portfolio where I'm constrained in terms where an additional constraint is added to building a portfolio, that is a constraint of a certain ESG score. By definition, I'm precluded from picking certain stocks or weighting certain stocks the way I would want, which means that given that my choices have been reduced, I should probably expect to give up some return. And if you look at the kind of the first curve, the black curve, the one to the left, you could see that it stands on a slightly higher tangent than the green curve, which is the ESG curve on the right. Now, by the way, the source of this is AQR, who produced this chart. And I actually walk into this course as a professor kind of thinking this is true. And people will debate this, and may be the case that most of my students will disagree. But this chart does not give credit for outperformance by virtue of targeting a certain ESG score within the portfolio. So if you believe that companies with stronger environmental, social governance policies are going to exhibit higher stock performance, then you don't really believe in this chart. And probably people who are supportive of ESG investing from a purely economic perspective probably don't agree with the chart. But if you believe markets are efficient, then perhaps you do believe in the chart. So I thought I would just start with it. Maybe if we could move to the next one. The chart here is from some work done in a research publication coming from Morgan Stanley called Sustainable Reality. And what they did is they looked at Morningstar's data on mutual fund performance and just looked at the performance of sustainable versus non-sustainable funds and looked at the difference and did it for 15 years. And if you look at the chart, and I've got a chart with maybe a little more detail on the next page, but the same idea, you could see that they're very, very close. There's really not been a meaningful difference in performance between the two types of funds. Next slide. Okay, and again, this is the same chart, but same data presented a different way, and it just looks at the difference. The green is sustainable, the blue is traditional, and the purple is just the difference. And if you just eyeball the averagings, again, it's pretty close to zero. But what they do find, next page, is that if you define risk the way that the report did, which is looking at something called downside deviation, which is just looking at volatility when the performance is below a minimum threshold or minimum accepted return, they find, and this was also the case in a study that I just got put in one of my classes from Morningstar, where they basically find that the deviation on the downside, or the risk on the downside, is greater for traditional funds and for sustainable. So basically, if I was to summarize their findings, they would say that that historically, over at least using this 15-year period as a sample, return is not much different. Risk is actually a little bit lower. So if you then look at the relationship between return and risk, or the Sharpe ratio, you would say the Sharpe ratios are a little higher for ESG focused, in this case, US equity funds. Next slide, please. This is another slide I just put together for the course. One of the analyses I'm going to show in the class is I'm going to compare what I think is probably the 5 most popularly quoted indexes on ESG. So just to kind of put this in perspective, if you make the decision for whether it's economic or impact reasons, and I love Sandra's chart, and I'm going to ask her to borrow it, I think, for my class. But if you are looking for an ESG-focused equity portfolio, you could either go passive or active, just like you could in a regular portfolio. And as a result, if you go passive, you actually have quite a fairly large selection of passive indexes to choose. And I'd say the 5 most popular index providers in the ESG space are shown on this page. From what I can tell, based on what I've read, and also based on the amount of assets managed according to these indexes, MSCI probably being the most popular, especially in the exchange traded fund space. But so what this chart does is it looks at 1 year, 3 year, 5 year, and 10-year performance of each of the indices. And if you just kind of go through it, what I like to do is look at the longest period I can find typically. And if you look at it on the S&P 500, obviously the most well-known index, the ESG is actually outperformed, but you got to be a little careful, I think, in that some of these indices have backdated performance, and there's always some potential for biases when you backdate data. So I just say that with a small caveat, but you could see the ESG outperformed the regular S&P. You could see in the case of the Russell over the common period, the regular index slightly outperformed. In the case of the MSCI USA is the regular MSCI index without ESG focus. And you can see within MSCI, there's actually multiple ESG indexes. And depending upon which one you selected, that defined relative performance. Bloomberg, actually, the ESG index underperformed. And if you look at Morningstar, it kind of depends again on which ESG index you select. I would say, if I was to summarize this, I would say it's kind of a mixed bag. And I would also say that the performance differences haven't been that large. Last one for me, next slide. Okay. In trying to compare these indexes, because the way I looked at it, the way I'm going to look at it in the course is if you choose for, again, economic or impact or both reasons to develop an ESG portfolio strategy, and you're thinking of doing it from the perspective of not picking stocks yourself, but choosing a manager, you could either go active or passive. And in the class, we're going to discuss multiple frameworks for both. But if you go passive, your decision is twofold. One is what index to choose, and 2 is how you're going to execute it, whether you're going to buy an ETF, an exchange traded fund, or a mutual fund. So to help frame the first question, I looked at the largest holdings of all the different indexes to just try and get a sense as to which ones are most different. And I think what you'll find is when you're choosing an index itself, the choice is whether you want a very focused, concentrated index, like say, for example, the leaders indexes, whether it's MSCI or ESG, their construction rules allow them to veer fairly far away from the traditional indexes. So you could see their stocks, MSCI, for example, ESG leaders from MSCI doesn't include Apple, which is, as all you know, probably the largest company in the United States. And if you look at the Morningstar ESG leaders, most of the large stocks are in the US are not even in there, versus something like the S&P 500 or the Russell, where they are relatively close to owning all of the large stocks. And in fact, the S&P 500 ESG index might already include Tesla, because Tesla was just added to the regular index. So there may be a lag between when it goes into the regular index and when it goes into the ESG index. So I think my presentation, again, looking at it more from an academic perspective, is really designed to frame the rest of the discussion. And with no further ado, I'll pass it to Sam to do that. I presume if anyone has any questions on any of my material, you'll ask when we have the question and answer session towards the end. Sam, you're up.
Thank you, Professor Zurack. That was great. So good morning, everyone. Welcome to this morning's panel. I'm CBS21, and I'll be moderating for our panelists today. Very excited to introduce everyone. So today we're hosting Olivia Albrecht from PIMCO, Head of ESG Business Strategy. Navindu, I'm sorry if I butchered this, Navindu Katugampola, Global Head of Sustainable Investing at Morgan Stanley, John Paluska, EMBA 21 of Columbia and VP of ESG Securitized Products at B of A. And we're very excited to have everybody here. So this is going to be a good conversation. And I just kind of want to get started with a question that I think is pretty general about just sort of defining what ESG kind of is, and just getting, for anybody who's unfamiliar in the audience, the acronym ESG, environment, sustainable governance, is environmental social governance, is very straightforward. But can we talk a little bit about what ESG is and sort of how it's measured, and maybe from the types of measurement systems available for ESG? Start with anybody.
Oh, I got myself off of mute fast. Sorry, Navinda. Maybe I'll get started and then turn it over to you. First off, thank you, Professor Zurack, for your comments in the slides ahead of time. The debate about performance is alive and well. In fact, we're just internally going through some additional debates again, and would love to use some of those slides, and we use some of those data sets as well to help focus the attention in terms of the different views that you can have on what the performance impact is. Let me first make an observation about how we see ESG investing to frame kind of two different lenses in terms of what ESG investing really means. And then I'm going to dig into what the performance implications might be and some of the challenges with measurement. First off, ESG investing we see as two separate pillars. One is there's something called environmental social governance integration, which is really about how do we as research analysts, portfolio managers, evaluate non-financial factors, or what have historically been non-financial factors in the categories of environmental, social, and governance into the broad research process. How do you incorporate anticipations of policy or regulatory changes, consumer preference differences, the hunt for talent, climate change, climate risk, physical risk, transition risk into business models? How do we, as stewards of capital, look at these factors and incorporate that into the research process? That's really ESG integration, and that's pretty well proven to add value to your investment decisions. Simply turning a blind eye to ESG factors because your clients didn't tell you to build an ESG portfolio is no longer sufficient. You have to evaluate how business models could have large quantities of stranded assets in their balance sheets. You have to evaluate how health and safety of employees will affect a company's long-term ability to attract and retain talent. That's our fiduciary duty. So that's ESG integration. Separately, there's another world called ESG investing, which is focused on solutions around sustainable objectives and themes in portfolios. So when we think about these investment strategies, it's a bit like the Morgan Stanley research that Professor Zurack put forth, which is ESG labeled funds and solutions. And this is where it gets difficult because there is no one size fits all approach to ESG investing, similar to there being no one size fits all to equity investing or to credit investing. There's a multitude of different ways to build ESG labeled funds and solutions. And so it's hard to make a holistic comment that says, here's what the performance impact of an ESG fund is versus a traditional one, because there's no universal definition. So I think that starts to create some of the challenges there. Historically, a lot of research was focused on exclusions, and does exclusions, create positive impact or not in terms of portfolio performance. Now we have these ESG scores, which we can evaluate how indices or portfolios performed over the years to answer the question around performance. But I think it's still a challenging question to answer even with those data points, because we have to remember too that ESG research has really grown since its early days 10 years ago to where it is today, where you can't kind of just project today's ESG scores back over the past 10 years to assume that companies' ESG metrics were the same 10 years ago. So I think it's a really nuanced space. The questions that Professor Zurack presented up front in terms of performance and what the trade-offs are live and well. I just observed that there are these kind of two ways of defining ESG investing. One about ESG integration, which feels like it's pretty well put to bed, that adds benefits to the research process. And then the separate category, which is a bit more convoluted and complicated, which is, there's no one size fits all approach to an ESG investment strategy.
John,
Yeah, thanks very much. So I think Olivia summed it up very well in terms of how we look at it at MSIM as well, in terms of ESG integration versus what you might consider, top-down sustainability strategies, looking at outcomes as well as integrating sustainability into your investment process. I think there's a couple of things that I would add to what Olivia said. First of all, ESG integration, and this is particularly relevant, and it was quite interesting to see the data earlier on from Professor Zurack on passive strategies, because MSIM is exclusively an active fund manager. And our approach to ESG integration, and I think this is a critically important point to emphasize, it's not about investing for good, it's about good investing. It's how we actually, as an active fund manager, are able to generate returns and outperformance for our clients. And as Olivia touched upon, part of that is making sure that you've identified and hopefully mitigated risks that might be related to sustainability, be it that on the environmental side or governance or social, but it's also about how we identify and capture opportunities as well, how we generate alpha by seeing, looking at a particular sector and thinking about, which companies in that sector are best placed to benefit from things like the clean transportation impetus that we have, or the energy transition, or around changing patterns of labor management and how we're unfortunately all working today in this sort of post-pandemic environment. So it's also about thinking where sustainability related opportunities lie that could potentially lead to company outperformance, and therefore if we can participate in that, also an opportunity to generate alpha. With respect to top-down ESG strategies and thinking about, as I mentioned, essentially an additional outcome for your investment approach to not just look at return, but also some sort of sustainability aspects. And as Olivia said, you can think about this almost like as a layered building block approach. So at the one end, you can think about just excluding certain things to try and manage risk, and sectoral exclusions or norms-based exclusions, excluding really controversial companies is sort of the starting point. But then the way we think about that is how that could be built up to sequentially to think, first of all, using things like scoring methodologies, as Olivia mentioned, to try and lean into the stronger performers around the sustainability side. But then there are a couple of further levels deeper you could go to think about thematically what's important to you. Do you want to try and construct a portfolio with a low carbon footprint? Do you want to try and construct a portfolio that helps support diversity and inclusion? Are you focused on a broader agenda with respect to developing markets and reduction of poverty? So those sort of thematic objectives can be layered into an approach as well. And then there's the question of whether you want to invest for impact as well. So not just favoring those companies that are doing a good job on their carbon footprint or their workforce management, but actually favoring those companies that are helping find the solutions to climate change or find the solutions to poverty. So there's a whole spectrum from sort of minimizing risk and excluding things towards leaning into the stronger performers and ultimately into impact. But there's a third pillar that I think is important to emphasize in terms of what ESG means to us. And again, it's it's particularly relevant for an active fund manager. And that's our role as a responsible steward of capital. It's not our money that we manage it on behalf of our clients. And with our clients' money, ESG also means to us that, not just being an active manager in the sense of, selecting securities, but also being active on engagement as well, pushing issuers, pushing companies on environmental, social, and governance issues. And when we see deficiencies, encouraging them to do better. And when we see companies that are doing well, encouraging them to aim for excellence and continue that trajectory. So incorporating sustainability into our conversations and into our active approach to dialogue with issuers is a third pillar I'd highlight in terms of our approach, and also helps inform the investment process as well.
I think, first, thank you very much, Sam, Professor Zurack, and Sandra for inviting me to this important conversation. Olivia and Navindu did a great job of, summarizing kind of from the strategic framework here. Certainly there are a number of challenges, that we have headwinds ahead of us, in addition to, many tailwinds that we've seen in the last 18 months. But, there's, I think, Sandra put it really well when she said and had that slide up that, investors were looking at return first, impact second. And, I think ESG, or, socially responsible investing, which has been going on for nearly centuries, it was essentially started from negative screening. And, two thoughts that, whether you're looking at, avoiding risk, or you're, have, a moral standard of, wanting to not be a part of, some type of, affiliation, and better the portfolio of the investment. So, some of these other challenges that I think we're really seeing and, will come to light, are, the regulatory challenges, the adoption of ESG standardization. There's a lot of different nonprofits out there that are, these different corporations are working on their sustainability reports and, how they're reporting carbon or social impact, which is, can be a difficult one. We talked a little bit about, governments and proxy. And then how do we rate this? There's, a 0 to 100, there's an A to F, there's a, a green, yellow, red out there. And so, while we look at this, it's, there's no one fits all ESG. These companies and investors are going to align with, their priorities of, ultimately the 17 United Nations Sustainability Development Goals. And you'll have to prioritize what's most important to you, and you can fit most of those in there. And maybe later to your point there, Sam, or the different parts of a company's capital structure. There's lots of opportunities in each of these investments, and Professor Zurack pulled up some of the equity ETFs that we've seen outperform. You can look at the debt side of the investment grade debt. The use of proceeds for a green bond or a social bond, sovereigns, whether the government, governance stability, different political and institutional strengths, cash management, risk reduction, alignment with, various veteran, minority groups, women. I think there's a lot of tailwinds behind us, and it's an exciting space to be in right now.
Thanks, everybody. That was helpful. I'd like to follow up on a few of the points that were made, and maybe Navindu, I could start with you. Given that the difference in perspective between active management and passive management, and that there's this sort of Venn diagram of ESG implementation from the corporate side, ESG investment from the investment side, and looking at Professor Zurack's slides earlier, it looks like there's a significant crossover between the ESG ETFs and indices and just technology companies in general. And given that there's that sort of large crossover, both outperformed and were considerable sources of alpha recently over the last few years. So I'm curious, given that there's all these different types of ways of measuring ESG, and some tech companies might not rank high on some of those ESG metrics, Is this sort of like the tail wagging the dog a little bit between tech and ESG, or as we're learning more, this measuring stick is getting better and we're going to see maybe some of those technology companies come out of those ESG indices and not be such a driver for ESG in the future?
Yeah, it's a really good question, Sam, and there's several bits to unpack here. First of all, and again, I confess a bias. We're an active fund manager, so when we look at indices and passive approaches, we're obviously looking at these and trying to look at them objectively and trying to interrogate what exactly is achieved there. So let's start there. There's two different types of sustainability index that are out there, and Professor Zurack might like to comment a little bit later. You see broad sustainability indices looking, trying to isolate the strongest sustainability names versus excluding the weakest. And then there's those that are more focused thematically, like, for example, low carbon footprint indices or climate aligned or Paris aligned indices as well. So let's take that second group. The problem with having and most examples of low carbon indices that I've seen is they tend to be sectorally biased. So it's very easy to construct a low carbon portfolio by saying, you know what, if I go overweight tech and financials and underweight energy and utilities, hey presto, I have a low carbon portfolio. You've achieved precisely nothing. You haven't helped the energy transition. You haven't helped drive decarbonization, but you optically have a low carbon portfolio. So, big question about whether that's actually the right way of going about constructing a portfolio like that, and whether a more relevant way of approaching it is to think about, sector by sector. Can you find those issuers and those agents that are performing better than their peer group on a carbon metric? And that sort of analogy goes then through to broad sustainability indices. And the first question to ask is, are they sector neutral or are they sector biased? So again, you gave the example of tech, and they seem to be very much skewed in that direction. But the other question to ask is, where do you draw the line, and what's the consequence of drawing that line? So if you set that bar too high for inclusion, and Olivia mentioned this earlier, that sustainability used to, I think, historically be all about excluding the bad stuff, or the worst performers. But if you set that bar too high and are only investing in companies that are already doing well, you miss out on two things. First of all, the opportunity to identify the next wave of companies that are making progress on an improving trajectory, and actually support those companies through your capital by investing in them to help them continue on that trajectory. But you're also potentially sacrificing opportunity, again, going back to my point, to capture alpha. If you're investing in companies that are on an improving trajectory, hopefully that participation in that journey will actually allow you to generate returns to your clients by getting those companies to a good point. So thinking about where you draw that line on, when you're thinking about a sustainable portfolio and what's included versus excluded is extremely important. And the last thing I'd say is, this is sort of addressing the tech question head on. Clearly, not just tech companies, but technology as a whole has a role to play in our transition to a more sustainable economy. But it's critically important. This is a fundamental premise of the way in which we invest. It's critically important to realize that every sector in the economy, and indeed, sovereign, securitized products, all asset classes, all types of issuers, have a role to play in sustainability transition. To focus exclusively on one particular sector, like tech, is to miss the 90% of other corporates involved in other industries that also need to transition their business models. And that's part of how we approach our investment philosophy, which is to think about not just on a sector by sector basis, but also thinking about individual issues within sectors and how they are making a positive or indeed negative contribution towards a more sustainable transition.
Maybe just to chime in here, Navindu, you brought up so many great points. I want to hit on this kind of sector tilt. I want to bring in the dimension of fees and what do you want to pay for? And then I want to spend a moment and talk about the tech sector just in general. And I think why you're seeing some of those tilts, just to almost defend it a little bit. And then I want to broaden out the conversation and just talk about the dispersion of ESG scores and just kind of unpack that to a certain extent. So first, I mean, again, when you think about some of these passive strategies, they tend to, as we've observed, tilt toward the tech sector and exclude the high fossil fuel and high carbon intensive industries. And the question for me always is, how much are you willing to pay for that? That's a very static approach. It doesn't have a lot of meat behind it. So that's why I think you see it, the bulk of those solutions coming in the form of low fee ETFs. You miss a lot of the opportunity for dynamism from your active manager. You miss a lot of opportunity to be engaging to drive impact and to drive change with companies and other issuers around the world. So, there may be this, natural bias for a low fee solution, but you know what you're getting, which is that you're getting a tilt toward tech and healthcare and other less carbon intensive by definition industries, and you're going to avoid these higher carbon intensive industries like utilities, like the fossil fuel industries. That might be well and good for you, but just know what you're getting and why you're paying lower fees for an approach like that. Second, to come to the tech defense to a certain extent for why you see that natural tilt. They have done an incredible job in terms of leaning into their sustainability commitments. And I think that you see that just from the leadership of some of the largest tech companies. I'll give a couple of examples. And I just spent 2 hours on the phone hosting the treasurer and the CFO for Alphabet this week with our teams, exchanging ideas on their sustainability commitments. Over at Alphabet and Google, their ambition is not to become a net zero carbon emitter, which they have already achieved through a variety of different means, including renewable energy for their warehouse facilities and their facilities around the world, data centers around the world, but also through some carbon offsets. But their ambition is to actually become a 24/7 renewable energy user. That's very ambitious. That means that they're going to set up solar panels, wind farms, wind technology, all sorts of different approaches to have an entire ecosystem that runs off of a 24/7 renewable energy platform. That's what their ambition is. Certainly from the tech sector, they're focused on cybersecurity and privacy and other social dimensions that they're highly focused on and have been very ambitious on, and it's a core part of their business models. I think that's why you see some of those social scores kind of bump up for some of the tech sector. Microsoft is another great example of an early leader in terms of their sustainability commitments. I think from 2012, they started to put a carbon tax on their business units internally. So if the presidents of business lines are utilizing anything but renewable energy, they have to pay money back to the executive office to fund those investments or to fund those decisions. And I would note, as Lucas Joppa, their chief sustainability officer, always likes to say, he set the carbon tax at 5 times the market average, just to make it even more onerous and to lead to the right decisions. So I think you've seen the tech industry really lead, and I think that's part of why you see their ESG scores as pretty high. Although frankly, sometimes you see their governance scores a little bit lower, given board and founder and C-suite dynamics. So I just wanted to make that observation. Lastly, just to kind of round out the discussion here, like there's no one size fits all to ESG investment solutions, as we've talked about, there are not yet one size fits all approaches to what are the material, environmental, social, and governance factors when evaluating certain industries, sectors, and companies. I think that we are miles ahead of where we were 10 years ago, and great strides from 5 years ago, and great strides over the past couple of years to harmonize what are the material factors for each of the different sectors and industries. But it's still a little bit of a work in progress. You give a hat tip to the Sustainable Accounting Standards Board for their materiality mapping, which is a publicly available, and has created some consensus around what's material in terms of these factors for different industries. But there's still deviations and there's still differences of opinions. That shouldn't make you worry, shouldn't make us worry as active managers. It actually creates ripe opportunities for us to have different opinions between service providers and other asset managers. And that's a good thing because we can capture value from that perspective. But just as a data point, just to round out the comment, the S&P, Fitch, and Moody's, their credit ratings have like a 99 or 9.99% correlation. Whereas, MSCI, Sustainalytics, any number of these third-party data providers for their ESG scores have a 0.66 correlation. So there's huge dispersion still. It'll reduce over time, but in the meantime, Navindu and John and I will continue to find ways to generate alpha with those differences of opinions.
Yeah, some really great points there. And I think, maybe just two thoughts from my side is, one, technology is technology. And so they kind of had a running start on this. And, they had to look in a position where, heavily on the E side of it initially, energy is what, is the most expensive cost to them, probably beyond their employees. And so looking at transitioning to, sustainable energy solutions, solar, wind, water, et cetera, is why they were early adopters and some of the first to come out and announce their, negative or net zero carbon goals. And to a second point, I think, one thing that we maybe haven't fully studied yet, but we have seen some of the effects is the COVID-19 pandemic. Tech firms were driven largely, by, I think as Olivia mentioned, cybersecurity. We moved to this work from home environment and the need for technology, the need, for different, data companies, et cetera, to be working for us and supporting us behind the scenes. That's been a tremendous driver. And so, you can also look at the COVID-19 pandemic, and we could have a whole nother conversations on this of different ways that companies and corporations, investors have looked to support on the social aspect, governance as well. But I think techs definitely saw a lift from the COVID pandemic, supporting those that needed the work from home.
Sam, can I weigh in? I just want to add a few points just because they were relevant to some of the slides I showed. First, in terms of the indices themselves, some of the indices do not put a lot of industry constraints on, but others do. So for example, the S&P 500 ESG index actually picks the highest rated ESG companies within an industry. So there's not necessarily going to be a meaningful misweight within a sector of an index like that versus an index which doesn't really put that constraint. And those indexes could wind up with a larger weight in tech. And just to reinforce what Olivia mentioned earlier, and this is something I start my course with, one of the difficulties, and she mentioned it very, very well, is that the classification systems are different from one classification provider to the other, much more different than, say, the bond ratings. And as a result, there's still no consensus towards whether any given company scores high or low on ESG factors, which it seems to me is moving towards some reconciliation. And I suspect it'll be a matter of time before the industry standardizes that a little more. But for now, if you pick MSCI, you pick Sustainalytics, you're going to get a different answer on any given company.
Thank you, Professor Zurack. So this is cribbing a little bit off of some of the questions that are coming in from people, and it's about the stakeholders in ESG and the connection to sort of long-termism and how that might be a little bit different than how companies are sort of evaluated on a quarter-to-quarter basis in the Wall Street research framework. And I was wondering if I could ask you all about sort of squaring the different agendas between all the stakeholders in ESG, between corporate governors, institutional retail investors, policymakers, and more, as well as sort of who is going to be the driving factors behind some of implementing some of these ESG policies, and whether or not we could see like a change in the framework around which companies are going to be evaluated to take into account the long-termist sort of implementation plans that ESG fundamentally has relative to the quarter by quarter basis companies are today evaluated on?
Maybe I'll just start.
Maybe I start if I. Oh, sure. Sorry, John. Go ahead.
I'll be brief here. So I think there's the carrot and stick approach here. When you talk about governance, there's been a lot of governance issues highlighted recently in the last year. I think tech, we briefly spoke about, has seen a lot of challenges, and they may still have some challenges ahead of them. What we're seeing over in Europe is there's some legislation that I believe will go in effect in March about mandatory sustainability reporting. Looking at whether that will come to the United States or will be relevant, and how do you put all the different frameworks to provide one standard across different industries and asset classes. I believe stakeholders, shareholders, employees, they all want kind of their own seat at the table. And it was in 2019, the Business Roundtable got together. There's 100, plus nearly 200 CEOs, kind of all made that general commitment, that they would do right by, the people, by the shareholders and all stakeholders involved. So, is it going to be a defined change that it's going to be a carrot? I don't think so. I think there will be some stick behind this. We have a new Biden administration. I think there's a lot of legislation that we'll probably see that may prompt companies to get there, so they're not laggards and they're leaders. I would say that what Professor Zurack kind of showed earlier, and those who were leading didn't have to take the stick approach, and we're certainly leaders in the space. So maybe I'll just let Navindu go ahead and follow up.
Thanks, John. Yeah, I agree with all of that, and I think maybe to put in context of how we look at it as an investor. I mean, all the relevant stakeholders that essentially have a role in a company's overall sustainable strategy can have an influence on corporate direction. And I think if nothing else, the one thing that the pandemic has taught us that all of these things are interlinked. So companies are having to solve for multiple stakeholders, whereas before that may not have been the case. So as John said, regulation acts as a push factor. You have to comply with regulation. You have to think about, as changing criteria and constraints start being implemented, how your company is essentially going to be future-proofed against that. And as an investor, one of the things we'll assess is how companies are performing relative to that, the pace of regulation that's being implemented, and whether they are on track to meet things like if there's a pace towards electrification or clean energy, or how are they responding to that. But then similarly important is consumer behavior, and consumers, particularly post-pandemic, are paying attention to how companies have managed their supply chains, how they may be managing the diversity and inclusion element, that's around how they've made their products and services available to vulnerable communities, historically disadvantaged communities, and your entire consumer base is paying attention to that now. So again, as an investor, we need to be mindful of that. We need to see how companies are reacting across and keeping essentially keeping their consumers positively minded towards their own sustainability performance. And the last thing, and pretty critical again, our fundamental thesis as an investor is a company is built on its employees, and how companies performed through the last 12 months in terms of managing the health, the safety, the well-being of their employees, keeping them motivated, and ultimately helping them through this period of very seismic change that we've all experienced, is going to be very critically important to how productive those employees are as we move through, hopefully, to the recovery phase of the economy. So it's really important how companies have thought about sustainability in the context of their employees as well. So all of these things are interrelated, and they're all important to us as investors, because we need to think about the relative performance the companies have in relation to these different stakeholder groups, and what that means at a very fundamental level to their bottom line when we're evaluating them as investable prospects.
Yes, agree with all of those constituents that were identified. The only one that I didn't hear, and so I'll mention it, which is a more of a fixed income lens of the world, but the role that credit rating agencies and credit rating agencies play, I think is really critical. And I think it has captured the attention of CFOs and corporate treasurers in a way that 5 years ago it hadn't, it being ESG or sustainability. Today, S&P, Fitch, Moody's, all of the rating agencies are trying to figure out how to get themselves into the business of ESG, but also how to reflect in their credit ratings of issuers these non-financial factors, which are impacting cost of capital and are impacting business models and are impacting companies' ability to repay, which is what they're supposed to evaluate. So I think the more that you see the credit rating agencies invest, and they're investing millions and millions of dollars to up their game here, I think that you're seeing the capture of mind share from CFOs and treasurers in a way that you didn't see 5 years ago. So I would just add that to the queue of confluence that's coming together to drive this space in a way that 2021 feels fundamentally different than years prior in this space. So of course, it's wonderful to see all the advancements from that perspective.
Yeah, thank you. And bringing in some more questions from the audience there, I'm wondering how SDG frameworks sort of come into the equation here, and whether or not using those as a crutch to improve the measuring process is leading to better results in making a more accurate measurement process, and whether or not these SDG frameworks are just still a little bit too amorphous to actually implement, and they'll improve over time just like all the other measuring sticks will.
I can speak to maybe just a few quick examples on the fixed income side. Coming from a securitization background and familiarity with investment grade debt capital raising. So you see green bonds. I think you briefly touched on sustainability bonds, and those we see being aligned to a certain goal. And I'll use the environmental for example. And so you have a large telecom or tech company that's going to issue out a green bond, or maybe a company that's going to do an asset-backed securitization issuance, and maybe the automotive industry. You're going to see the use of proceeds, or you're going to see the collateral align with the UN SDGs, that will achieve carbon neutrality. And that's, I think, kind of the general goal that some of these issuances are trying to achieve. I mean, certainly there's social goals and various governance goals, but I think the E side of it is certainly well defined at this point, and those are just maybe two quick examples.
Maybe I'll chime in here to maybe a slightly different view, and I'm going to make a comment that this is my own personal views, not attributable to my firm or anyone else that I spend time with. I think that the SDGs are still, somewhat in their infancy in terms of utility for investors. I think the greatest utility that you see with SDGs is that John had highlighted in the context of some of these use of proceeds bonds, where you can really look at the underlying projects and initiatives and try and align to the 17 SDGs and their 160 plus underlying target metrics, and you can draw a stronger line. I think that when you see investors try to utilize the SDGs as a mapping framework for S&P 500 holdings, I think it gets a little bit questionable. To say PepsiCo is a great company, it does great things on sustainability dimensions, and let's pick out SDG number 6 on no hunger or zero hunger for the world. well, PepsiCo creates food, so they must be helping on the no hunger side of the equation. It may be true, but it's a much more complicated picture for PepsiCo, given its environmental platform, given the content of the food that they have historically created. I think trying to shoehorn broad investments into the SDG framework can create challenges. The utility for me seems to be in more customized, unique investments like an SDG bond, like a green bond or social bond, or in the private side when you're making individual investments, say in infrastructure development or renewable projects. So just some broad observations.
And maybe just a final comment for me, and I think Olivia summed it up very well. That for us, the SDGs is a useful output framework, an assessment framework, and something we can use as a guide. But it doesn't necessarily it's not necessarily an input for us into our process. And again, I just want to draw a distinction as well between when you're thinking about a company. And if you're using this as a framework of looking at a company, it's also relevant to think about drawing a distinction between a company's business practices and its products and services. And the two things are different, and the contributions, both positive and negative, to the SDGs could also be different. So, when you think about business practices, diversity and inclusion is a good example. So you can have a company that's very strong on business practices because they have a very positive or progressive diversity and inclusion policy where they have strong female representation, minority representation amongst the workforce. That's different to thinking about their products and services and how the company, through the things it manufactures or through the loans it gives out, are actually targeting more diverse and inclusive communities. So for us, both aspects are important, and we use the SDGs essentially as one useful assessment framework, thinking about companies' positive or negative contributions through their business practices or products and services across these various dimensions. But it's one of a multitude of frameworks that are in use, and essentially are isolating ultimately the same thing, which is thinking about the relevant aspects of materiality when it comes to sustainability and what's most important for a particular company.
Great, thank you. So it looks like we are running short on time. So I'm going to round it out with a final question here for the entire panel. So given that there's no shortage of capital going into the ESG sector, and it's coming from all directions, from institutional, retail, sovereign, it seems like there could be a lot of really interesting developments coming up in the next several years as ESG evolves. So can all of you just sort of touch on what some of the more interesting developments we're likely to see in the next few years could be, and what are the most exciting developments on the horizon further into the future?
Oh, I got myself off mute first, so I'll take a stab at it. I see three key areas that I'm super pumped about. One would be the trillions and trillions of dollars that have been committed to net zero commitments by asset owners around the world, from the largest sovereign wealth funds, pension plans, insurers. And they're making a commitment for their trillions of dollars of assets for all of those to sum up to zero for the carbon emissions in those portfolios. That is incredibly ambitious. Thank God we have 3 decades to get there, but working from 0 to 30 years from now and figuring out what the solution set is to get us there, as the opportunities will ever increase as companies, sovereigns, municipalities, and everything in between make their own commitments to net zero. I know that we'll be able to achieve it, but I think this is going to be a really cool area to watch. There'll be a lot of analytical tools and systems and data that are needed to support this transition. But I think it's really incredible to watch just the trillions and trillions of dollars that have been signed on to these commitments. And we're having calls every week with asset owners to discuss how can we help them achieve those objectives. Second would be, I think, the thematic solutions, particularly on the fixed income side of the equation, where there haven't been as many thematic fund offerings to investors. I think you'll see an increase in those thematic strategies as the opportunity set widens. We launched a climate bond strategy about 13 months ago, after we had felt very confident that the opportunity set was large enough and that we could provide an innovative solution to investors wanting bond holdings that were delivering climate solutions. I think that the world ahead will look like we'll have more thematic solutions in the fixed income space that we haven't seen before. And then lastly, and perhaps a bit obvious, would be the social dimension. This was one of the questions I think that came through during the Q&A as well, which is, what will the social research platform look like in years ahead? And I think that the short answer is it's going to get a heck of a lot better. Today, we have really scant information as it comes to social diversity factors at companies and at sovereigns and municipalities. We need more data. I think we'll get there. Just as a frame of reference, when you look at the S&P 500 companies, less than 15% of them report gender diversity data across their employee base. Less than 10% report that data on racial diversity metrics, and less than 5% report any disability in their employee base. I mean, there's just the sky's the limit. There's a lot more to do in terms of social. So I think that you'll see in the years ahead, there will be a greater focus on metrics, alignment, standardization as it relates to social dimensions.
Maybe I pick up where Olivia left off, and I think I'm going to zero into the fixed income market in particular and see and sort of highlight specifically there what I'm particularly excited about. And I want to pick up on social where Olivia ended, because again, we've had thematic issuance of labeled green social sustainability bonds in the fixed income market for quite some time, going back over 10 years now. But in the last year or so, we've seen an enormous acceleration in the issuance of labeled social bonds, targeting either social issues or target populations, in particular vulnerable populations. So that is very much symptomatic, I think, of the direction of travel, and very much emphasizes Olivia's point that the focus on social that's being really coming to the forefront of corporate thinking is now materializing in the bond market in the form of social bonds. The second point that I'd like to make is, and again, this is also a really encouraging sign. And when the labeled bond market first started, it was all about green bonds, and most of the issuers were multilateral development banks. Then that slowly broadened out to energy and utility companies in particular issuing green bonds, very specifically focused on climate change. Subsequently, this market is well over $1.5 trillion in total size. And what's really exciting is the broadening out of in a variety of dimensions, different issuers from different geographies, issuers across different industries, and a whole range of environmental and social themes that have been supported across the full spectrum of the capital structure and rating scale. So that's encouraging. This product has very much gone from something relatively niche and small to very much part of the mainstream. And the last thing that I wanted to highlight that I'm particularly excited about, and it goes really to the heart of, I think, the area that all of us on the panel are focused on, which is fixed income specifically, and the role that fixed income has to play in helping bring about a sustainability transition compared to equity investors. And I think, if we're honest, for a very long time on the sustainability side, the equity side of the house had prominence because they're the ones that turn up at the shareholder meetings, vote the shares, and so they very much had the ear of the C-suite of the corporate management level. But the simple reality is the vast majority of the financing that a company does is in the debt capital markets. And those interactions are when companies come to us in the primary market, is when companies are trying to raise money directly with investors. The majority of equity transactions happen in the secondary market. So that gives us tremendous influence and responsibility because we have those direct interactions with those companies when they come into the market looking for money to help drive their CapEx and their OpEx. And the majority of sustainability objectives and strategies in their implementation, if they require CapEx or if they require OpEx, they're probably going to require debt financing. And that's why I think we as fixed income investors have a tremendous role to play in catalyzing this sustainability transition. And that's something that we take quite seriously, and but it's also something that we're very excited about going forward. So those are the three things on my side.
I think there's a lot of great points here made in some that I would have covered. I'm really excited that people from all sides of the table are now getting involved, and the growth will continue across all of these products, and it's going to be sustainability reporting is going to be really critical to understand. We're going to see more integrative reporting through SASB, GRI, the CDP, TCFD, working with the rating agencies, working with the various accounting firms, and best how to disclose data, how to use data, on a standardized approach. And so I'm really excited to see kind of the developments, for that. Companies need long-term capital, to be sustainable, to achieve these goals. They need active ownership, the proxy, and second to this, hopefully this will achieve, and what we have seen, especially in, as Navindu mentioned, we're seeing lower cost of funds, more stable, positive returns, lower borrowing cost. A big part of this is, better transparency. A couple times we mentioned during this, talk about, diversity, inclusion, and bringing in diverse thought. You're seeing a lot of board changeover at this point. Coming from a Army Green Beret background, if you didn't have diverse thought, then you couldn't figure out a solution. And then maybe the last point, and also on the fixed income side, but is the sustainability linked bonds. These are going to look at sustainability performance targets and KPIs. Whether it's tied to the use of proceeds or the various collateral from something that might be asset backed. So those are a few that I'm very excited about.
Great, thank you all. This has been a great conversation and really great thoughts shared here. So Professor Zurack, do you have anything to say before we round everything out?
Thanks, Sam. I do actually, and it's still something I'm trying to get my head around. Where I think things are going to head in the long run is I'm not sure in the asset management world there's going to be a such thing as ESG, meaning that I think that what's going to happen is that the marketplace is going to figure out what factors correlate with rising stock prices, and they're just going to be part of the normal investment process. There's not going to be a standalone or a segregated investment process. It's just going to be one process. And therefore, the people solely motivated by economic desire to maximize returns are going to figure out which of these factors correlate with them and which don't. And then, so I think the market may bifurcate between people who are investing 100% on economics and people who have other objectives in their investment portfolios, and maybe come up with different portfolios. So that's where I think, and I could see listening to the speakers in terms of their institutions and how they're integrating ESG, and in doing research for my class and kind of lining up speakers for my class, I found the same thing. Everybody, it's becoming just part of the mainstream rather than a separate area within an asset management organization. So that's kind of where I see it going.
Yeah, we might have to add a new factor to the factor investing equation from Fama French. Great, thank you all. This has been great. Really appreciate the audience joining us, and yeah, looking forward to having more conversations like this in the future.